Welcome to The Explainer. So today we're unpacking a puzzle that literally every single entrepreneur faces, right? Business financing. You've got this amazing vision. Maybe it's a disruptive new tech platform, or honestly, just the perfect neighborhood cafe. But here's the thing, a brilliant spark isn't an engine. You need capital to actually build it. Okay, let's dive into this. Where does the money actually come from? Think of capital as the essential fuel. It's the fuel that takes that initial spark of an idea and turns it into a roaring, functioning engine. In this explainer, we're going to map out exactly how businesses fuel up.
Here's our roadmap for today. 1. The spark needs fuel. 2. Internal financing. 3. External financing. 4. Debt versus equity. And 5. Choosing your strategy. We're breaking this complex beast down into 5 simple steps.
All right, Section 1, the spark needs fuel. Let's ground the financial reality here. Let's be real, financing is the absolute lifeblood of your business. We're talking about buying equipment, making sure your employees actually get paid, renting that office space, running marketing campaigns, and eventually expanding your operations. It's kind of a harsh reality, but a massive percentage of startups fail simply because they miscalculate their runway for these very basic, everyday necessities. Without that capital, your innovation just stalls. You literally have to build a rock-solid financial foundation from day one. Moving on to Section 2, internal financing. This is your own personal fuel. So internal financing, a lot of people call this bootstrapping, is money that comes strictly from inside the business or directly from the founder's own pockets. For most small businesses, this is absolutely the foundational first step. You're fueling the engine entirely on your own dime, setting the initial value of your company way before outside players ever get involved. Now, what's really interesting about this slide is the strategic trade-off. Relying on sources like personal savings, retained profits, or selling off assets gives you absolute 100% control. You have zero debt and zero outside voices telling you what to do. But the ceiling is pretty low. Your personal reserve tank is finite, right? And that creates a natural bottleneck for rapid growth. Basically, you're capping your own speed just to maintain total autonomy. Okay, Section 3, external financing. Time to look for outside fuel. Eventually, for a lot of businesses, that internal tank hits empty. That's when you have to open the doors to external financing. We're talking about money from outside sources. This means bringing in third parties to fund your operations and push past your organic growth limits. And trust me, doing this fundamentally alters the entire dynamic and scale of your operation. So here is the ultimate founder's dilemma, laid out clearly. On the internal side, you've got a shield, right? Full control, full autonomy, but your funds are strictly limited. On the flip side, external financing unlocks this massive treasure chest of growth potential with abundant outside sources. But, and it's a big but, you instantly invite outside influence and introduce a whole new level of operational risk. And this brilliantly illustrates the landscape of those external options, which, honestly, is a bit of a strategic minefield. Look at bank loans. They drive aggressive growth, but they totally threaten your cash flow. Then you have investors. They give you capital with absolutely no repayment pressure, but they take a seat at your decision-making table. What about crowdfunding? Well, it democratizes your fundraising, letting you pull in small amounts from lots of people. But you need an incredibly strong, viral idea to make it work. And grants? Hey, it's free money. But surviving the labyrinths to actually qualify for them is incredibly tough. Choosing the wrong one here can actively hurt your business. All right, Section 4, debt versus equity, the big showdown. Big companies, by the way, often use a mix of both of these to grow faster. Let's define debt first. This is borrowing money like securing a bank loan. Taking on debt allows you to leverage outside capital while fiercely protecting your 100% ownership. But what's the catch? Well, it adds a really rigid, non-negotiable legal burden to your monthly cash flow, and you've got to repay it with interest. That interest compounds whether you're having a phenomenal month or a truly terrible one. Now, equity completely flips the script. This means selling a part of your company, like bringing in angel investors or venture capital. The huge pro here, you relieve that immediate pressure on your cash flow because investors share the risk with you. There are no strict monthly payments hanging over your head. But in exchange, you are actively diluting your own stake. You're giving up a permanent slice of the pie. It really is a brutal crossroads. Look at the comparison. Debt means you keep your ownership, but you sacrifice your cash flow by repaying with interest. Equity means you protect your cash flow since there's no repayment, but you sacrifice your ownership. As a founder, you really have to ask yourself, are you more protective of your equity or your monthly margins? Section 5, choosing your strategy. Let's get practical and talk strategy. Before you go out seeking a single dollar, you need to strip away all the emotion and ask yourself some really hard strategic questions. First up, how much money do I actually need? And I don't mean some ambitious back-of-the-napkin guess. I mean the precise mathematical figure required to hit your very next critical milestone. Next question, how fast can I repay it? If you're thinking about leveraging debt, you absolutely must stress test your cash flow realities. You need to ensure those monthly payments won't suddenly sink your entire operation if, say, sales unexpectedly dip for a couple of months. Then ask yourself, am I willing to share ownership? Honestly, this is a massive ego check. How much of your grand vision are you truly willing to compromise when an outside investor pushes back and completely disagrees with your strategy? Because that will absolutely happen.
Finally, what risks can I handle? You really need to know your own breaking point. Can you sleep soundly at night with a massive mountain of debt hanging over your head? Or, conversely, can you deal with an aggressive board of investors scrutinizing literally every move you make? The wrong funding can destroy your business, so knowing your risk tolerance is paramount. So the crucial point is, remember that lenders and investors are asking hard questions too. Take banks, for example. Their assessment criteria are strict. They will rigorously stress test your repayment ability, scrutinize the macro conditions of your entire industry, and demand physical collateral. They are protecting their capital just as fiercely as you're protecting your business. I want to leave you with this thought. Money isn't everything, but without it, nothing moves. It's so true, right? Passion, talent, innovation, those are absolutely essential. But capital? Capital is the underlying physics that allows all those amazing intangible things to actually scale and become real.
So it all comes back to you. You understand the levers now. Debt, equity, bootstrapping. The path forward is entirely in your hands. So what fuel will you choose to drive your dream? Strategize carefully, choose wisely, and take that next big step. Thanks for joining me, and we'll see you in the next explainer.